The big topic about when to set your trade to break even, when to take profit, how to trade your stops. Most of the money is made in your exits in trading. And while I can totally understand that going to break even will take a lot of pressure off and taking partial profits will make you feel better or even increase confidence in your trading strategy maybe, it will cost you money in the long run. What I did in the beginning was that I took partial profits. I opened 2 positions whenever I went into a trade. I took partial profits at the first pivot point and then I trailed the rest. While that is an absolutely fine approach, it cost me money in the long run. As I found out with my trading journal, it cost me actually 1/3 of my performance, so I could have done 30% better each year. And taking partial profits can be good for your psychological health, as I already said. But if you can deal with the fact that maybe 3, 4, 5 trades in a row you are not going to make any money and then you make up for everything and much more, if you can deal with that, then taking partial profits doesn't make sense at all. As I said in the beginning, I even advocate to take partial profits because it will give you the ability to gain confidence in this strategy, in your abilities as well, and also you can make steady money while still training the strategy, and it will give you more confidence to stay in trades longer. Because if you have already some profit locked in, it will be much easier for you psychologically to let a trade run. So let's take a look at this example. If you go short around here somewhere, you put your stop 3 pips above the high. So here roughly, down here was our entry line. As soon as this swing happens and we get a acceleration through this trend line here, this is when I would minimize my risk already, pulling my stop down to here. Now I'm at 7 pips risk. And as soon as we hit the pivot down here, I pull this stop down into the middle of this move, locking in almost my risk. So now I'm at 1-to-1 risk-reward ratio. And now I simply observe what price is doing. So this is where you could take partial profit, 50% off, and your other position would be here 50%. Breaking below this, so what I'm doing is I pull it a little bit deeper. Often there will be retests of the pivot, so we don't want it on the pivot, we just want it a few pips above it. We got the retest, and now we are going deeper. So now I'm pulling my stop above this consolidation. And now we hit the next pivot. So now this trend has gone on, this whole move here, these whole 53 pips without a single pullback worth mentioning. So what you can do down here is take full profit for, okay, so 17 for 53, that's 3-to-1 roughly. That's absolutely fine taking profit down here. Or you can again observe what price is doing down here and hope it will continue. I would take profit down here, that's for sure. So this would be where I'm out, but let's say you keep your stop here because you think this will keep going. Now we have this swing, so I would at least pull my stop down here and then almost get taken out probably. And once I see this swing down here, okay, first if we went all the way down here to S3, I would pull my stop into the middle again between these pivots and get taken out probably. And if not, I would pull my stop above this swing and then finally get taken out. So the win rate that we get from this strategy, if you can achieve the win rate that I get, because I never ever enter a trade if I don't get at least 1-to-1 risk-reward ratio to the next pivot, I am already profitable if I take profit every time at the next pivot, because my win rate is around 60 and 70%. So 65% with a 1-to-1 risk-reward ratio makes you an excellent trader. But I can make much more money if I stay in a trade longer. So this is why I took profit down here. I don't want to be too greedy, and usually after a move like this you will see a 50% pullback maybe to this pivot, and this is where you get the re-entry opportunity. So it makes a lot of sense to take profit down here, re-enter here and write it down for the second wave. Now here we didn't get a pullback this deep, but I'm still very happy with my decisions to take profit down here. When to set your stop to break even is quite easy as well. as we use sweet spots, we use these round numbers. So whenever price comes to a round number or to a pivot, you go to break even or you lock in profits. There's another criteria for going to break even is if your trade, for example, goes down here and it's in the middle of nowhere, and then we get a stock turning up, we get a strong momentum candle in the other direction, then usually we go to break even as well, because we don't want to get taken out on a full-blown reversal. But until that happens, you simply trail your stop behind these swings. You minimize your risk on a trade as soon as possible. Alright, let's say you entered here, for example, and you put your stop 3 pips below, and you entered long here on this candle for whatever reason. And now you get this candle. This is not a reason yet to get scared out of this trade. Okay, you have a very tiny stop, 11 pips, and you have a potential huge profit because price most of the time is revisiting this level up here. So we don't want to get shaken out of this trade too early. But now, when we come close to this pivot point, this would be when it's time to go to break even, and we would get taken out, which is totally fine. And of course you could have taken profit up here, 16 for 11, even better than 1 to 1. So, to recap, you trail your trades behind the breaks of the pivots and behind the swing lows and highs. You don't touch the stop until something in price action tells you that it's okay to eliminate your risk or to minimize your risk. For example, we make a pullback, which we can hide our stop behind. We break through a pivot, which we can hide our stop behind. Or price makes a pullback in the direction against our trade, and we want to eliminate risk. And then we simply trail our trade until we reach a pivot point which we think will at least result in a temporary reversal, and if we exit at that point, we get a sufficient risk-reward ratio, and most of the time we also get a re-entry chance if price should decide to continue. That is basically how we trail our trades, how we go to break even. And premature exits of trades can cost you a lot of money. Usually I play it in a way that either I find an opportunity to bring my stop to break even, unless after my entry price sometimes starts ranging. For example, if I went short here for whatever reason and price starts doing this, then I simply get out for a small loss or for a small take profit, because we are momentum traders. So we want price to take off soon after our trade, or our trade idea simply didn't make sense at all or didn't work out. That is the only time when you really are allowed to get out of your trade with a small loss or a small profit. That is how we manage our trades, that is how we bring our trades to break even, and that is how we lock in profits. If you have any questions about this method, or if you have an idea for your own profit trailing and profit taking, then let me know in the forum.